Okay, so now next, the main talk for tonight is going to be done by Professor Douglas Abrams, who's a visiting professor at Sasin Graduate Institute. He is also the founder and CEO of Expera, which is a Singapore leading incubator, and he's launched 2 seed stage and 1 early stage fund in Singapore since 2007. He had his MBA from Wharton, and he used to work with JP Morgan for more than 14 years. Without further ado, let me introduce Professor Douglas.
Okay, thanks for the kind introduction, and good evening, everybody. So I'll just briefly review my background. I think it was pretty much covered, but yeah, Wharton to JP Morgan to Singapore to set up my first venture capital fund. And since then, I've set up 2 Expire funds and 1 joint venture fund called Extreme Ventures. So 3 venture capital funds since 2007. And I've been also teaching entrepreneurship at the National University of Singapore since 2001 and teaching venture capital at Sasin since 2007. So point I want to make here is my topic today is venture capital in Southeast Asia. And I've been doing venture capital in Southeast Asia since before the beginning. So yeah, 14 years in Southeast Asia venture capital. It's like 98 years in any other industry, because these internet years are like dog years. Each year is 7. So I'm going to try to share some of my insight, what I hope is insight and experience over this time. Granted, I have been doing the investment in Singapore from 2000 until now, but I've also been traveling, teaching in Thailand since 2004, at Sasin since 2007, and have been indirectly investing in Thai companies by helping my former student from Sasin set up Singapore companies so we can invest through my Singapore fund. And this year, along with my 2 partners here, we've launched a first venture-funded accelerator program in Thailand. I'll talk a little bit about that later. So now we have actually direct investment here too. I'm very excited about this topic and about this industry at this stage of development. Now, what I would like to do, I have slides that I'm going to go through, but I'm much more interested in answering questions from you, hopefully making this much more interactive session rather than a lecture, because I had been doing lectures for 5 weeks at Sasin. So maybe I can start out by just getting a quick understanding of who's in the audience. So how many people are entrepreneurs? Okay. How many people are investors? How many people are interested in becoming entrepreneurs or investors but are not currently entrepreneurs or investors? Okay. Did I leave anybody out? So everybody's either an entrepreneur, investor, or interested in becoming one. Great. So I usually like to start out every presentation with my favorite Chinese character, which is, can somebody read for me? Wei Ji. Wei Ji. Yeah, we're going to have a short Mandarin lesson in addition to the talk. So Wei Ji is a Chinese character that means what? Sorry, my former students or students that are hearing this for like the umpteenth time, but I see most people here are not former students. So this means what? Danger. And? Correct. Danger and opportunity. So the single word translation we usually hear for this character is crisis. This is also the logo for my company, Expire. So if you get my card, you'll see our logo is crisis. And I start every one of my presentations with crisis. So usually this gets an immediate question. Why are you doing that? Because what's your impression of crisis? It's a good thing or a bad thing? Good or bad? Potentially bad. So potentially bad is the same as good?
It's hopefully good.
Yeah, actually, I believe it's neutral. So crisis is not good or bad. Crisis is a situation that's reached a critical turning point. It's either going to become good or going to become bad very soon. And that's the same sense we get from the Chinese character here, which encapsulates this concept of danger and opportunity inextricably linked. And how are they inextricably linked in what we're talking about today, which is venture capital Southeast Asia, is I like to think about this in terms of risk and return. So in more sophisticated translation of this character, we would say, in order to get to the opportunity, we have to pass through the danger first. Or within every situation of danger, there is opportunity, which is a very nice way of saying we want to generate more return, we have to take more risk. So this is what venture capital is about. Venture capital is all about taking maximum risk. If we're not taking enough risk, then we're not generating enough return. This is why people invest in venture capital. So in the people that, when I invest my own money, or people that invest in my funds, they invest because what? They want to buy what? What are they buying? They're buying risk. What did you say? Yeah, there's opportunity, but they're buying a certain type of opportunity, which is risk. They can put the money that they're putting in our fund in any other, asset class that has less risk than ours. The reason they're coming into this fund or making this type of investment is they want to buy more risk. So why would anybody want to buy more risk? They want to buy more risk because they want to increase the return in their portfolio. The return in your portfolio is directly proportional to the amount of risk that you're taking. If you're not taking enough risks, you're not getting enough return. How many people are satisfied with their current level of portfolio return? Perfectly satisfied. So only one of us out of about 50. How come everybody else not satisfied? Oh, I'm also highly satisfied. So actually 2 of us, but I don't want to jump in. So the reason is everybody else not taking enough risk. You can only generate the required return when you're taking sufficient risk. So if you feel not satisfied with current return, right after the workshop, just go and take more risk. But I guess if you're all entrepreneurs, that's a highly risky undertaking, so that's good. If you're considering investing in entrepreneurs, that's also good. So when we start thinking about there's a seat here. When we start thinking about venture capital from the company side, so everybody knows generally what venture capital is, right? What is it? Everybody signed up for the workshop, or came to the workshop because they thought the topic of venture capital in Southeast Asia was interesting somehow. So probably it's like you must have a general idea what it is, right? Is it everybody did not eat dinner before workshop, right? So, yeah, venture capital, we make investments in small private companies, and usually start companies, meaning typically companies in ICT, energy, or biotech who are planning to grow big relatively fast. So that's a general definition. Now, you might wonder from the entrepreneur perspective, why do entrepreneurs seek venture capital? Why might an entrepreneur raise venture capital for their business instead of self-funding? Why do they do that? I like to have this talk with every entrepreneur in my first meeting. When I first meet with an entrepreneur, and even before I hear their pitch, I want to know, I ask one question. What's your aspiration for the business? What's the aspiration for your company? Why do you want to start this company? What are you hoping to accomplish? And there's some consistency in the answers, but people have different goals. Like, let's say I'm starting my company because I want to be self-employed. I want to be my own boss, and I want to do what I want to do, and I want to do that for the next 20 years. That's great. That's a great reason to start a company. But now you can't raise venture capital, because the only type of company that can raise venture capital from, anyway, professional investors is the entrepreneur starting the business with the intention of growing it big, fast, and then selling it, or enabling us to sell our shares. That's how venture capital works. So we invest, we help the business grow big and fast, and then we get a chance to sell our shares. either in an IPO trade sale. I'll go through that in a little more detail on a later slide. But when I try to explain this to entrepreneurs, and one interesting thing about doing venture capital in Southeast Asia versus, say, the US, although I never did venture capital in the US, I worked in financial services for 14 years at JP Morgan, but not doing venture capital. But I do know some entrepreneurs and something about the entrepreneurial ecosystem there. And in Southeast Asia, we have a lot more first-time or maybe less sophisticated entrepreneurs who may not really understand exactly how something like venture capital works. So I will always have this talk with them. What do you want? When you think about this business, oh, we have a seat here. People who come late are punished by having to sit in the front row, right? It's always a... Yeah, some people are very good in going to the front row right away. So I always say, what do you want? How big do you want your pie to get? Do you want a small pie or big pie? And there's no right answer. I mean, having a small pie all to yourself can be great. But if you want to have a big pie, you're going to have to share. There are no big pies that you get 100% of. Why? Because small pie that the entrepreneur keeps 100% of, we call a lifestyle business or lifestyle entrepreneur. This is the entrepreneur I talked about before that starts a company because they want to pay themselves a nice salary and be the boss. The companies that we invest in are all companies that can grow to significant size that we can sell. In order to get the company to significant size, it's going to need more money than it's likely to have as a self-finance company. Therefore, they're going to have to share. Entrepreneurs are going to have to share ownership in that company because the most common form of investment that we do is equity investment. We put money in the company, we get shares in the company, and later we sell those shares. So they're going to have to share ownership if they want to grow big. So either choice is okay, but a lot of, especially first-time or less sophisticated entrepreneurs, they can make a mistake of having, one foot on each side. I want to grow big, but I don't want to raise money. That's a recipe for failure. If you want to grow big, you have to raise money. Or I want something like a lifestyle business, but I want to raise money. This also doesn't work. So you have to be clear from the beginning as an entrepreneur, what's your aspiration for the business? If the aspiration is you want to grow big and relatively fast and generate a high return for yourself and investors, then you can raise money, and if not, you can't. If you can't raise money, then you self-fund, or you fund with bank debt, or you fund with friend and family money. There's nothing wrong with that, but you can't seek venture capital. This I talked about already, but this, to me, it's the most important chart in venture capital or any financial investment. We need to make sure that our level of risk that we're willing to take is mapping to our level of desired return. So why do people invest in venture capital? This is a chart from US. I'll talk later about some numbers from Southeast Asia. Now, I use US numbers for the overall returns because we have a long history, a big data sample, and we can get real numbers. So later I'll show how I see in my own experience that our results map pretty closely to this. But this is a chart of the returns to venture capital funds as of this year, looking at about 1,500 funds. And you can see when we look at the, let's say, early stage, which is the type of venture capital that we do, over the last 10 years, 15, 20, 25, and 30-year time horizons. So these venture capital funds, on average, have returned 82% per year. Over 15 years, 47%. Over 20 years, 27 over 25 years, and 20 over 30 years. This is net of fees to the fund manager. So that's why I said, like, you want more return, you need some venture capital in your portfolio. And you look at the Dow Jones or the S&P 500 over the same period, instead of 18%, we're getting 8%. Instead of 31%, 9%. So that's the bottom line. This is why people invest in venture capital. This is why every institutional asset allocator, almost all institutional asset allocators, have 5 to 10% of their portfolio in venture capital because they know that they can, if they choose wisely, can generate returns like this in this portion of their portfolio. I like to put this number in because in Singapore, a lot of investors are gaga about real estate and have been since I got there. So I always like to point out that the 30-year returns to real estate are about 4%, and this is this nominal return not taking into account the transaction costs. So now, Southeast Asia real estate, it's done better than this, but long-term returns are going to converge on something like this. Any questions about this? Now, okay, so does anybody remember when this chart appeared? What's that?
5 minutes ago.
Oh, when it was first in the news? There was actually there was a previous year. Oh, there was a very interesting interpretation of a previous chart. Right before this chart came out, the one before this, previous quarter, the 10-year venture capital numbers were slightly below Dow Jones and S&P 500 because that one 10-year period was the period that covered funds that lost money in dot-com crash. So all the other numbers were the same except for 10-year. And the headline on that story, internet, was venture capital is over. Underperforms equity indices. So I think it's a great lesson in don't believe everything that you read on the internet and make sure you drill down past the headlines to check the underlying data. So this one, maybe you're familiar with or not, but this is, I call the venture funding process. So companies start out here and go to here. Oh, actually, everybody's welcome to take photos of the slides, as many as you want. Also, if you want the whole slide deck, you let me know and I'll send you all the slides. So totally optional. Photos, or can video me if you want, and can ask for the slides. So companies go along this chevron, starting with founders capital. They'll go through seed or angel round funding, through traditional venture capital rounds, which we letter Series A, B, C. Some might do mezzanine round, some might do pre-exit round, and then all, if they're successful, end up at exit. So how does this work? Every company starts with OM. Every entrepreneur starts their business with OM, which means what? Own money. OM is own money. So as a VC, we expect to see that the entrepreneur has invested some of their own money in the business before they have come to see us. Now, why is this? There are two types of money in the world. There's OM, and the other type is what? OPM. And OPM is what? Other people's money. So every dollar that you have, it's either yours or other people's. And the relevant point there is most people have very different attitude toward OM and OPM. And the main difference is what? Like, which are you more willing to spend? Your own money or other people's money? Other people's money. Yeah. I mean, everybody thinks they're different, but I mean, a lot of people think they're different. But okay, let me do a thought experiment. Like, how many people raise your hand and keep it up if you've flown on an airline, commercial airline? Keep it up. If you've flown in economy class, keep it up. If you've flown in business class, keep it up. If you paid for that business class ticket yourself, keep it up. Yeah. So, okay, it's okay. Now, so you see the drop off, right? So for people that flew business class but didn't pay for the ticket themselves, who paid? The company, right? Now, okay, now your company paid, and the reason they paid was they have a policy that says if you fly from point A to B, you're entitled to business class ticket, correct? And you just took that ticket, and you didn't hesitate for a second, correct? Now, let me ask you, did you think about going to the travel office and saying, hey, for this trip, I know I'm going New York to Beijing. I know it's like a 20-hour flight, but I would like to take a voluntary downgrade to coach so that we can save money for the shareholders. No, nobody ever thinks about doing that, right? Like, I didn't do that when I was at JP Morgan. Like, at JP Morgan, what I did, along with a lot of other people, was when the company changed the travel policy, so when we flew from New York to London, we had to go business class instead of first class. We bitched and moaned. Got to sit in business class like that, and then, yeah. So I think that's how people look at other people's money. Now, if you think about it, when you're putting your money into company, you don't want the entrepreneur to have that attitude, right? You don't want the entrepreneur to think, okay, finally I got some funding and I'm buying those first class tickets. You want them thinking, every time they spend money, it's our money. So your money commingled with my money. Now, sometimes we also like to see not just own money, but the FF&F money, which is what? The friends, family, and fools. Yeah, so everybody knows that. It's a little bit of a joke. Why? Because friends and family, they don't do the full due diligence on your investment. They just give you the money because they love you. So we think maybe people that come in at that stage without loving the entrepreneur, they may be a little foolish. But I have actually invested a lot at this stage myself, so I don't really think it's foolish. But this is, why do we want to see some friend and family money? That can be one, but I would always say don't put too much of your friend and family money in this business either. Like, yeah, because chances are you're going to lose. Chances are they're going to lose all that money. Actually, I didn't show I don't think I have my failure rate slides here, but looking at US investment, so again, where I have good data, about 2/3 of all first stage venture invested companies fail. So that means the overwhelming likelihood is you're going to lose all your friend and family money. So it's okay as long as they can, accept that level of loss. But why do we like to see? Because we want to see that somebody else believes in you besides yourself. Like, let's say even your friends and family won't invest in your business. Even the people that love you and know you the best, they won't put $1 in your business. Why? I mean, that's a question, right? It's something that we think about.
Did you just say 2/3?
2/3. Oh, sorry. One half fails. About one half fails, and another 16% deliver less than one-time return. So yeah, thanks for correcting that. But okay, so if we look at the actual pie chart, we'll see about 50% go to zero, and another 16% deliver less than one-time return. But less than one-time return in VC talk, what does that mean? That means also zero. So that's why I said fail. Fail to deliver more than one time the investment. Why do I say that? Because when we account for investments, if the investment goes to zero and we lose everything, we'll count as zero. If the investment goes to, let's say we have these tables and chairs left at the end of the company and we sell them for $500, that was less than one time. We invested $1 million in a company, but we sold some assets. We got back a tiny, tiny percentage of what we invested, but hey, it wasn't zero. So you can effectively lump those together. Okay?
How long do you consider reasonable to wait? I mean, a lot of discussions I hear like this don't seem to take time into account. I know you want to sell out quickly, but it seems like there's a value in selling out sooner than later.
So so good question. So when I said we want to sell relatively fast, what does that mean? Like, it depends on where we come in on this continuum. So when we invest here at Cedar Angel stage, we expect average to be 7 years to exit. When we invest in, Series A, we expect about, let's say from here 5 to 7 years, from here 3 to 5 years, from here 2 to 3 years, from here 1 to 2 years. Here we should be within 12 to 24 months. So this is for ICT investments. If it's biomedical, then the timeline can be different. And even within biomedical, timelines can be different if it's like drug development or medical device. But I would say from here to here, average is if the company makes it to exit, average will be somewhere around 8 years. So I think it's not coincidence. It's not random either. How do we get these numbers? This is also the typical lifetime of venture capital fund. So most venture capital fund lifetimes are 8 to 10 years. Now, why do we have 8 to 10 year timeline of capital funds? Is because investors in venture capital funds want liquidity. They already have very long lockup. Even 7 to 8 years, it's an incredibly long lockup for most investors. So we usually strike a compromise between investors want their money back before they die, and right, there's a lot of the people investing in venture capital funds, they can be older, and they want to get the money back while they still have time to enjoy it. But we have to be realistic about how long it takes us to exit. Yeah, more questions?
Yes, do you always stick through all the way to the exit?
So no, it's another good question. Like whether we're able to stay in all the way to exit depends on a couple of different factors. Again, when did we come in? Do we have the ability to participate in subsequent rounds? So depending on the size of your fund and the mandate for your fund, you might invest only, for example, in my current fund, we just invest only in the seed stage. My second fund, we invested seed and Series A. The fourth fund that I'm raising now, we will invest again Series A and maybe do seed A and maybe B. So if you're in by Series B, then you'll probably be in till the exit. But seed stage investors or angel stage investors may come out at a later stage. It depends on who's coming in and what's the valuation and how much return you can make. So, okay, so more question? It's good. No, actually, I'm happier answering questions. I've done this, talk about this slide like 500 times already. Okay, so what's the difference between seed and angel investors? There's no like clear-cut difference. I'll usually say angel investors are individuals that invest in startups, while seed investors are institutional, like accelerators or incubators that also invest in early-stage companies. I'm also involved with angel investment in Singapore since 2002. I'm chairman of BANSI, which is Business Angel Network of Southeast Asia. So I do both on my own seed and angel stage investment. After we go through seed or angel stage, then we go through Series A, B, C. Not all companies go through all stages. Some might go through more than one, like 2 Series A. There's no magic in the letters. The key is that the sequence in time, so A always comes first, and then B, and then C, and the size goes up if the company is successful, and the valuation will go up if the company is successful. So I mentioned before, this is probably like 1 to 5, 5 to 10, 10 or more, and then if the company raises a lot more money, there can be even Series D or greater. So I'll talk about exit in a minute. You see the hurdle rates on these investment stages go down. We have a hurdle rate for seed stage investment that we estimate at 60 to 100% a year. If you think about what I said before, we're making seed stage investments for 7 years. This works out to, we're looking for something like 10 to 30 times return on each seed stage investment that we make. 10 to 30 times. And that's a minimum. If we think we can't get somewhere 10 to 30, then not interested. In real life, we're hoping to get more when we're successful. This is because why? Because fundamentally, our fund has to return the required return to our investors. So behind the venture capital fund, there's venture capital fund investors. Venture capital fund investors are looking at the chart that I showed you before. They want 30 to 35% a year if they're in an early stage. If in order for 66% of our portfolio to deliver less than one-time return, and for us to still deliver 35% after fees to our investors, we have to get average about 30 times return on each company that we invest in that exits. Now this sort of brings home in a very concrete way the pie chart I showed you before. What does it mean about going big? We have to go big because, let's say, how much money are you raising for your company? Let's say you're raising $1 million for your company. Or let's say you're raising $500,000 for your company in the seed round. If I want 30 times return, how much do I have to get when I sell? 15 million from my 500,000, right? So my 500,000 has to yield me 15 million. How much of your company am I going to get when I invest 500,000? How much should I get? 33. 33%. Done. That's a good deal. Yeah, I'm happy with that deal. Yeah. Okay, we'll talk after. No, it's reasonable. Okay, so I usually say like fair range. It's 10 to 40. I mean, the low end, and some deals might go down to 5. Deals that are, especially if you're super successful or raising very small amounts of money, deals above 40 almost only happen if the company's distressed or something is very wrong. So I usually will say somewhere between 15 and 35 will be about 95% of deals. So that's 30 is fair. A little favorable for me, that's why I jump on that. Like this one of my negotiation strategy, if we're any deals inside my range, I just do it. Yeah.
At what level do you require a board seat?
Oh, we require board seat every investment. So, okay, I usually do convertible preference shares in Singapore. In Thailand, we're doing some convertible debt, and we're offering convertible debt to some of our Singapore companies too. If we're convertible debt, we're convertible into redeemable convertible preference shares. Sometimes we'll have redemption and sometimes not.
Do you get warrants with that?
Not usually, but I'm open to warrants. But you're an investor, right? Yeah. So I think I have some strong views on convertible debt. Actually, I always advise entrepreneurs don't take convertible debt. But I will take convertible debt. I will give you convertible debt as an investor. So that should make you think why. Why am I so happy to do convertible debt for you? Like, I think the reason is it's more favorable for me. Therefore, if we want to do something that's more even for the two of us, then we should do, we'll do preference shares, which is equity investment. So everybody know how convertible debt works? So, okay, equity works like this. It's very simple. I put money in a company, and in exchange, I get shares. In this case, maybe I got 20% of the company. And later, I can sell that 20% when we sell the company together, either in an IPO or in a trade sale. But another form of investment, especially very early stage, we can do something called convertible debt. So convertible debt, I loan you the money. I loan you the $500,000, but this loan has conditions attached that enable you to force me to convert that debt into equity upon pre-agreed events, like usually you raise another round of funding above a certain amount within a given amount of time. And that's the rub. So you can force conversion, like typical convertible debt for $500,000, I would say, okay, if you raise around 1 million, or let's say in this case, maybe 2 million, within 12 months, you force conversion at 20% of the next round valuation. Now this means we don't have to negotiate about valuation now. We just negotiate a discount to next round. So this is what causes entrepreneurs to get so excited, because if we think about the math, like I put in 500,000 at a reasonable, let's say 20% valuation, 20% equity for me. That means that you're valued at around 2.5 million post money. But if you can raise your 2 million at also 20%, that would give you 10 million post money. Me at 20% discount to that, I get 8 million. So you're like, oh wow, I can get the same investment for 8 million valuation instead of 2.5. Eyes light up, you want to do it. And that's great, except that's not usually what happens. What usually happens is you fail to force conversion because you don't raise the amount you need within the time frame. And now, guess what? Now I'm a debt holder. So debt holding for startups is a bad idea. Who knows who is Mark Cuban? Who's Mark Cuban? Owner of Dallas Mavericks, and what else? And yeah, one very well-known U.S. Successful entrepreneur, one of the few people that made $1 billion in exits in the dot-com boom. He became a very active angel and venture capital investor. He's invested in like 200 companies. He's the star of Shark Tank, which is a great TV show. If you're an entrepreneur or investor, you can download from iTunes or buy the CDs in MBK. And yeah, and it's real pitches. It's entertainment. Like I notice some people, they review Shark Tank and they're like, this is entertainment. It's not realistic. I'm like, hello, everything on TV, it's entertainment. You missed that part, right? So, but yeah, but there's some very realistic aspects of it. But to get to the point, I found a great video from Mark Cuban on YouTube where he says, oh, okay, and I apologize to everybody if this describes you. I don't mean to do an offensive way. But he says, anybody who starts a business with a loan is a moron. Convertible debt, it's a loan. I mean, yeah, it's a convertible loan, but it's still a loan. Now, why does he say that? Because why? How does debt work? We have to pay it back. We have to pay it back on a regular schedule with interest. So it only makes sense when we have certain cash flows. As a startup, we have the most uncertain cash flows in the world. So you take a company with uncertain cash flows and you map to a certain cash flow payback debt. Doesn't make any sense at all, because you're blinded by the valuation to next round, the discount next round valuation. So I always say, if you want to do it, I'll do it because it's good for me. Why is it good for me? Because now I have a note. When you fail to trigger, now actually interest keeps piling up. It's 10% interest a year, and it's added onto the principal, like Sopranos. So, yeah, because we don't collect the interest, we just accrue it. And then I've had so many, I had a couple of situations where the entrepreneur is so excited about this, and then they pass the trigger point, they didn't raise the money, and they see the interest piling up, and they're like, okay, I don't want this note anymore. Like, how do I pay it back? I'm like, well, you don't pay it back. And how do I force conversion? Well, you missed the opportunity to force conversion. Now I have an option to convert whenever I want. And, you know, I explained this to you when you came in, you didn't care, and now you got a problem. So that's it. I think something definitely, you know, the problem is, I'm going to say, if you're super confident, you're going to raise that next round within the time frame, you should do it. But everybody's super confident. Reality is most companies don't do it. So the one exception I would say is when it's very small amount of money. Like, for example, in our I4X accelerator, we do convertible notes, but we do for 250,000 Thai baht. It's like 10,000 Singapore dollars. If you can't pay that back in a year, like the company's down the toilet anyway, so it's not going to matter. But you take a 500,000 convertible note and it adds 10% interest a year. 3 years later, it's 650,000. It's not small change anymore. Oh, and I left out one thing. When you go to raise a venture round, so you want venture capital from me or another investor, one of the key terms in the agreement, in the first page, we're going to say, here's the valuation for the company, debt-free. Means the company has to come to us debt-free. So you have debt, who's going to pay that? Who's going to pay off? Not me. You have to pay it off before you get money from me. So hopefully that investor wants to convert, but they're not forced to convert, so now they can negotiate what's the conversion valuation, and you can get really screwed. Okay, anyway, so that's the venture capital process. So why am I so excited about Asia and Southeast Asia venture capital? Like I mentioned, I've been in this industry since 2000. I've seen it go through 3 distinct phases. So there was the phase from 2000 until about 2005, which was like 60-degree angle straight down. The dot-com boom busted, and venture capital in Southeast Asia went from very frothy beginnings down to nothing. Then but then it started to pick up like around 2005, 2007, and from 2008 until now, it's grown exponentially. I'll talk about some of the factors that led to that, but here's some statistics. We look at even from 2013 to 2014, VC investment in all of Asia increased almost to 40%. No, almost 2/3. And new venture capital and PE funds raising 113 billion targeted Asia just this year. And in Singapore, so where I'm based, venture capital investment went from 28 million in 2011 to 1.7 billion in 2013. Now, there is some controversy about this statistic. So I talked to the guy that wrote this story and did the research on this number because I think this $1.7 billion number is too high. But maybe it's twice too high. So I think real number is probably a few hundred, let's say about 200, maybe 400 million. So it's still a massive increase. But you see from 30 million up to 400 million, still 10 times in 2 years. This is a study that I did myself of looking at seed stage investment in Singapore in 2013. And I tried to use like a maximum weird contrast colors to make this slide difficult to read. So I can explain how it's working. Yeah. So I estimate, and again, this is not comprehensive because it's just from my own data collection, but I estimated about Singapore about $90 million invested in seed stage deals in 2013 alone. So about 264 deals, 70 million US in a country with 5 million people and GDP 274 billion. You compare this to the US at the same time, over that same period of time. So same period of time, there were about 900 deals done at this level in the US, total 360 million in a country with 300 million people and $1.5 trillion GDP. So Singapore, with 2% of US population and 2% of US GDP, invested in 30% of the deals and 20% of the dollars. So I think that's a pretty impressive statistic, considering that the US is the center of the venture capital and startup universe in the world. I mean, especially Silicon Valley in West Coast US. This is like the Hollywood of venture capital. So I think this is very encouraging statistics for what's happening in Southeast Asia now. And now Singapore is the leader in this space. So the numbers Thailand are going to be very different, but I believe that Singapore is leading the way for the rest of Southeast Asia to experience similar exponential growth over the next few years. Why were there so many deals done in Singapore 2013? It's because Singapore, essentially Singapore government embarked on a program to stimulate growth of venture capital in the startup industry in 2007, beginning 2006, but really ramping up 2007. And now we're starting to see the fruits of that in 2013, 2014, and beyond. So one thing I'd just like to quickly mention is some people that following this industry, they'll say, yeah, there's a lot of growth in Singapore, but it's all federal, it's all the government. There's no private activity. You got to look at the U.S. to find private activity, but it's nonsense. Actually, the U.S. federal government alone invests as much in small businesses as total VC investment just through 2 of their funding programs. If you add in federal contracts to startups or small businesses, it's about 4 times the amount of venture capital that goes into small companies, and this excludes all funding of state and local level for startups in the U.S. So actually, the U.S. government is a massive player in the venture industry there. We just don't see it because we're so focused on the things that are happening in a very small number of deals in Silicon Valley. And if you look at it on a GDP level, both the U.S. and Singapore invest around 1% of their GDP into programs supporting startups and small businesses. So no big distortion of the market by Singapore government. And in fact, you look at other countries that have a thriving venture capital industry, which is a very small number around the world, and they all have tremendous support from government, especially at the catalytic phase. If you go back to the 1950s, when venture capital started in the U.S., it was U.S. government fund-of-funds program that actually created this whole industry, and they did it in California. So how do VCs make money? I mentioned this before. They make money 2 ways, trade sale or IPO. You sell your company to another company, that's a trade sale. You list on an exchange, it's IPO. Which should you do? Now this is one of, I think, very interesting features of venture capital Southeast Asia, is many more companies exit. We expect many more companies to exit in trade sales. And actually though, this is a worldwide phenomenon. Again, I'm using US numbers here, but when we extrapolate these numbers worldwide, the proportions don't change much. So if you look at the number of M&A deals every year, it's a number of IPOs, there are about 10 times as many M&A deals every year as there are IPOs every year, 8 to 10 times. So that means you're 8 to 10 times more likely to exit in a M&A deal than in an IPO. That's the bottom line.
That's numbers or value?
This is number, and this is size. So this is, for example, in 2012, there were around 500 trade sales. There were 50 IPOs. Same thing in 2011. In 2013, you saw 480. So this was a slow year for M&A. And then if you look at the offer amount, so meaning how much does the company get from the IPO versus a trade sale, it's not that much different, except in 2012 because of the Facebook IPO. So there were a couple of, that one basically hugely distorted that market. Now the valuation will be higher at the IPO because the trade sale is selling 100% of the company and IPO is usually selling 15%. So definitely shareholders will have made out more, but in terms of the amount of money that's flowing out to the investors, it's about the same. So this is one reality. I talk to Singapore entrepreneurs. You're not going to exit in IPO. You don't just give it up. There's no point targeting that. But actually, you don't need to. I mean, we're seeing companies now that are purchased for $20 billion, $15 billion in trade sales. And this is also one of the great things about venture capital and entrepreneurship in Southeast Asia. We don't need to do billion-dollar exits here to make money. I was starting to work through one of these calculations before. Imagine I put in $500,000 in your company. I get 20% equity. I'm diluted about 50% by the time I get to exit. So that means I'll have 10% by the time I exit. In order for me to make my 13 million or 15 million on that deal, we have to sell your company for 150 million. That's it. 150 million, and I can make 30 times. We can't do that in the U.S. because the amount of venture capital that goes into companies is much greater, and the valuations at the early stage are much higher. If I invested at 40 million in the first round, which happens in some US deals, and I want to make 30 times, then we have to exit at $1 billion. So because of the characteristics of market here, we can make plenty of money, both of us, investing at a reasonable amounts of money at reasonable valuations and selling your company for a reasonable price.
Can I ask you?
Yeah.
This is a little bit of a long question, but going back to your slide that showed the seed and the ABC and so on. Should one see that exit there as being the IPO, or should one see that exit as being either a trade sale or an IPO? And if it's that exit mark on the right-hand side was an IPO, then where would the trade sale fit into that arrow?
Oh, it's
You
either.
understand what I'm asking?
It's either or. So you're going to get either IPO or trade sale.
Right.
Yeah.
But does a
It
trade
follows
sale tend to happen, let's say, between A and B stage?
Oh no, it should be about the same.
Should be about-
Usually companies, and it might take a little longer to get to IPO, and you might have to raise more funding. So you might do some additional rounds for IPO, but it still should be somewhere 8 to 10, like 8 to 10 years from start to IPO. You had a question too, right?
Well, no question. I was going to say one of the things I've been very successful with and lately is because of a lot of cash investors are coming out of Asia. They want stock companies, so it's buying NASDAQ shells and putting
Yeah.
companies in there.
So like reverse listing, right? Yeah. So that's another option, and yeah, this is another one that we can do in Southeast Asia that you probably can't do in U.S. market. And I see a lot of companies in Singapore do these reverse listings on ASX also, and you can do with very small companies and still make some decent money.
Sorry, what is that? So what is this reverse listing?
Oh, reverse listing is instead of doing a typical trade sale or IPO, we'll buy like a shell company in Australia that's already a public company. For example, ASX, it's already a public company. That company will buy our company, and then we'll list our company on that exchange, and we'll get some proceeds from that listing. So you don't go through the whole listing process yourself. You work with a company that's already listed, but it's inactive. So it's looking to, or maybe inactive, or it's not doing much. They're looking for a bump. So they think, oh, actually acquiring a company like Style Hunt would be fantastic for us. So they'll acquire you, then you'll go through issuing new shares, and you'll get a yield from that. But I would say, I mean, for me, this is a third choice, because once you list, so let's say once you list, if you want to go to a real trade sale later, then you have to sell a public company, take it private, so that can become some additional complexity. And I always think if you're going to shoot IPO, shoot NASDAQ IPO. Let's get that $1 billion IPO. So this is exit activity. Exit activity is what drives the whole process. And actually, this is why there hasn't been, tremendous venture capital activity before now, because there weren't exits. But this is cyclical, because until we have pipeline, there's no exits. So in Singapore, we got the pipeline flowing, and now we're starting to see exits. So this is my chart of value of exits with reported value. You can see it went from an average of 50 or less over the period that I was tracking here to 400 million in 2013. And number of exits also dramatically increase. In 2014 already, we have about 300 million of exits in Singapore. So I think we'll probably get back to this number in 2014 or maybe more, depending on the exit activity in Q4. These are all M&A. This is a list of some of the exits. So some well-known, some less well-known. Now these, the ones that are like this one, I did not include in my chart because it's not a real exit. But if I included quasi-exits like that and like some of the other ones that are really big investments, not true exits, the number would even go higher. By the way, this company, Nonstop Games, if you want to meet this company, they sit in our incubator in Singapore. So this is a company that came to us about 2.5 years ago. It's a gaming company. They do online multiplayer computer games. They came with one guy from Finland. Now they have 30 people in our office, and they sold the company this year to King, which is the publisher of Candy Crush. Who's played Candy Crush? Who played Candy Crush but embarrassed to admit in a group like this? Yeah? Nothing to be ashamed of. That's why they're so successful. And they sold the company this year for $100 million. Again, 100 million US, which is about 120 million Sing, This is all you need to do 30x, no problem. So this is a look at our returns from our first fund. So first fund from 2008 until 2014, we invested originally in 16 companies. This was pre-seed investment. We invested $55,000 per company. So 19%, meaning 3 of those companies have either gone on to exit or still running and growing. So we had our first exit last year at 36 time return, which gave us a 2.2 return on the total fund. And we had our second partial exit in May this year at 250 time ROI and 5.13 on total fund. So this gives us 42% IRR from 2008-2014 and 5.13x on the portfolio. And we still have 2 companies left because this was partial exit. And we divested only a small portion of shares. This company, we're now going through another round of funding. So likely returns will be even higher than this. Now, so these are I mentioned before, I show the US numbers, but these are real numbers from a Southeast Asia-based venture capital fund over this period of time. And we're mirroring very closely the early stage results from the US chart that I showed. So, where we saw somewhere over the same, over a slightly longer time horizon, generating 30%, and we're generating 42%. So what about Thailand? I talk a lot about Singapore because that's my experience, but I'm very bullish on Thai venture capital now. I believe that the historical challenges that we have here that have kept venture capital industry from growing as fast as, for example, Singapore, lack of exits, but we now see that that's changing. Enterprise ecosystem, lack of enterprise ecosystem, lower level innovation, legal corporate governance issues, so-called cultural attitudes. But I believe that all these factors have changed a lot in the last few years, and I've been coming to Sasin every year for the last 8 years to talk about venture capital, so I can personally see these attitudes changing. Now we have early stage valuations that allow profitable local exits, and we also see more and more local Thai entrepreneurs that have regional aspirations, which means they can go for regional exits. We have the ability to bridge between Thailand and Singapore. So for example, every Thai company that we invest in our accelerator, we set up investment vehicle in Singapore. The Singapore company owns the Thai company. Why? Because later when we sell, the multiple you get on a Singapore-based company is much higher than a Thai company, and we have no capital gains tax. So it's easy to do that. You can do for it costs $300 to set up the company, $1,000 a year to maintain it, and you can do it in 2 weeks. I mean, actually, you can do it in 48 hours and have everything done within 2 weeks. Now there's more and more focus on innovative segments. So we did the first accelerator program this year. We had 25 applications and selected 8 companies, all highly innovative. And environment's changing, and now more and more entrepreneurial energy is channeled towards scalability. Actually, I believe since I first came to Thailand till now, actually Thailand, national, let's say if there is a national character, it's much more entrepreneurial than Singapore. I mean, Singapore has some entrepreneurial tradition, but in Thailand, entrepreneurism is elevated to a very high level. In Singapore, traditional attitude is if you're, super high potential person, you go into government, or you go into MNC, or you go into investment bank or consulting. In Thailand, you start a hugely successful family business, and there's a long tradition history of that. I believe that this entrepreneurial energy creates great potential in young entrepreneurs here that we don't see elsewhere in the region. So what are some other exciting developments in the local venture scene? So I mentioned I4X, which is our Expira and Envest accelerator program. This is Thailand's first VC-funded accelerator. The telcos also have their own accelerators, incubators. So each of the telcos has launched within the last few years an accelerator incubator program. And there's more venture capital funds coming up in the last few years than over the last 10 years combined. And I reached the end of my time allotted. I have some, if you're interested, I can share this with you after the workshop, but it's more information about typical venture capital term sheet. And then this is my contact information in Singapore. So I'll be around after the talk. I'm also happy to answer more questions now. Any question? Yeah.
So the government's playing a big role in getting the VC market going. Do you see Thai government doing that all the time?
So, okay. So Yeah, so I'm not an expert on Thai government because I only come here, on a couple months a year. And but my understanding, I'll answer two parts of that. My understanding is that what I hear from my partners and friends here is that the Thai government is much more seriously looking at programs to support startup and venture capital companies, and that this is one of the policy priorities. So there could be more public sector support for venture capital and entrepreneurship in Thailand over the next few years. And also, another point I always like to make for Thai-based entrepreneurs is when you set up your company in Singapore, you can leverage some of the Singapore government initiatives too. I mean, we have done this successfully with at least two of our Portfolio 1 companies. We got a Thai entrepreneur. We set up a company in Singapore. We comply with all the regulations in Singapore that enable you to qualify for public sector funding. And we're able to get the best of both because we maintain a big operation in Thailand, but we also able to leverage public sector funding in Singapore. So I think it's good news for Thai entrepreneurs. They can still access public sector funding in Singapore, and I believe probably the level of support from government here is just going to increase. So whether I think they should do that, I mean, I can't tell. Again, I'm not so well versed on all the different things that the Thai government has to grapple with, but I believe that investing in entrepreneurship and venture capital is very good for the economy in the long run. And this is another slide I didn't show, but actually, if you look at countries with active venture capital and startup ecosystem, and you map to GDP growth, it's very closely correlated. So I think in the long run, it's a very good investment, not just for the startups and venture capital funds, but for the population in general. And there's good theoretical basis for that also. Yeah.
I've been told that.
It's not true. Everything
Thank you very much.
if you didn't hear from me, it's not true. Yeah. Oh, sorry.
I've been told that it's pretty well hopeless to try to get investment in Southeast Asia for hardware infrastructure types of projects. Basically, Southeast Asia is interested in web stuff.
Oh, so I would say
Comment about that.
I strongly disagree. I strongly disagree with every statement that starts with, I've been told in Southeast Asia it's impossible to do X, because there definitely. I've been involved in investments in Singapore in hardware and infrastructure, and I know other investors there that specialize in hardware infrastructure. So I don't think it's impossible. I think definitely there are trends in venture capital industry like every other industry. One of the trends over the last few years has been web and mobile, but there's still plenty of investment going into hardware and infrastructure and energy and biomedical. So I think hopeless is very exaggerated. It's not easy to raise money. It's not easy to raise money for any business. It's not easy to raise money in Silicon Valley either. You hear only the success stories of companies that raise money, but you don't hear the stories of the thousands of companies that fail to raise money there and everywhere else in the world. Why? Because generally there's oversupply of companies seeking money from a limited resource of investment, so most companies aren't able to do. But companies do every year, so it should be you. More questions? How about, yeah?
So you were talking about Thailand being a place where you see a lot of family businesses starting up. But would you say that family-based businesses are amenable to
No. So the point I was trying to make there was not that family businesses are going to be likely recipients of venture capital funding, but the entrepreneurial spirit that has motivated and driven so many Thais to start so many successful family businesses can also be channeled into investable venture capital investable businesses. So I think one thing that makes a successful, it seems circular, but one thing that makes a successful entrepreneur is entrepreneurial spirit. So when people have entrepreneurial spirit, they're more likely to become successful entrepreneurs. So I was using that to illustrate what I believe is a high level of entrepreneurial spirit in Thai tradition and Thai culture that speaks very favorably toward the future of entrepreneurship here. And actually, if you look at GEM, GEM is a global study of entrepreneurial levels in different countries, and Thailand always ranks very high. So there you go. Singapore, Actually, Singapore doesn't have a strong tradition of entrepreneurship in the same way. But now in the current generation, it's becoming more entrepreneurial. Yes?
I worked at the Ministry of Finance, so I'd like to know what is the exact model that U.S. government or the government of Singapore used to finance the startup?
Oh, so there's many different programs. There's like, I'm happy to talk to you about it after because this is an area of special interest for me. But there are scores, dozens and dozens of different programs that Singapore government has used to help stimulate the growth of the industry. I can tell you like some examples, like they do fund of funds programs. So fund of funds is when the government invests in venture funds. Now, interestingly, okay, I'll tell you the hallmark of the most successful Singapore government programs. And this spans a wide range of different structures, but the hallmark of the most successful programs I call public-private partnership. So this has been a very consistent strategy Singapore government has used to grow this industry, is to not try to do everything themselves, and in fact to mostly leverage the private sector to create multipliers on their dollars. So typically what they do is they'll set up, for example, a fund of funds, and they'll invest. Like my second fund, which is called Extreme Ventures, we got 10 million from Singapore government, and then we had to go out and raise another 10 million. And then we shared the returns with the government. But the government also gave us a call option on their shares. So this creates a very smart incentive for the fund to go out and raise $10 million, and also a smart incentive to generate returns so that we can buy their call option, so that we capture leverage on the money that they invested with us. They have programs that do straight grants, but straight grants are rare. Most of the programs they have are matching programs, so they do investment by investment match, where instead of investing in a fund, they'll match investments that the venture capital fund makes. Like, for example, my current fund, for every $105,000 that we invest, we get $150,000 in matching investment from them. And this gives us a almost 1.5 to 1 leverage ratio on our fund, which makes it much more attractive to do early stage investment. Because we actually capture the value of the equity based on their money plus our money. So the company, for example, gets $250,000. Example, like a seed stage company, they get $250,000 from us. We get, let's say, 25%, but we only had to put in $105,000 of our own money. So this type of program is very smart. So anyway, but if you're interested, I can ramble on about this for hours because because I pay a lot of attention to public sector funding in Singapore, because in this business, like any other business, you have a little bit of an edge, and it makes a big difference in the results. And Singapore government's very smart in incentivizing both entrepreneurs and venture capital funds to make smart investments. They made some mistakes too, so I can tell you about those. But the other good thing about them is, my experience with them, they learn from the mistakes. So they don't make the same mistake twice. They make, sometimes they make a big mistake once, but they don't make the same mistake twice. Other questions? Yes?
Have you taken a look at how 500 startups works? And if so, how would you describe their approach, and what's sort of your take on it?
Yeah, I'm not that, don't know in detail exactly how they work, but I know that they tend to invest in a very large number of companies. That's like sort of 500. So I think they look at pretty similar models, and then they invest like a relatively small amount of money in a lot of companies. I think that's definitely, they've been successful with that strategy. I think there's a lot of different strategies that work. I think for me, it's not, I do something a little like that, but not 500. I think, for me, I like to get like a reasonable amount of diversification, but not like machine gun approach. But the guys that run, at least the guys that run original 500 startup are super smart, and they're in a place where they're seeing a lot of high quality deal flow also. But I think the problem that we might see with that model here is, when you invest in too many companies, it's hard to provide the support for the companies beyond funding. So this is another very important point to make in Southeast Asia. As a VC, you're not a bank. Everywhere you're not a bank, but especially here, the companies require a lot of hands-on support after the investment. So if your portfolio gets too big, it's hard to do that. Unless the team is huge, and it's hard to have a huge team unless you have a big fund. So
What kind of support you provide?
So we focus on helping the companies to raise more money, because we're at the early part of this process. So we're always the first investor in. So our primary focus is to do what it takes to help the company get to next round funding. And in fact, over the same period, 2008 to 2014 that I show here, we helped our companies raise more than $40 million in follow-on funding after us, which it sounds like small money, but in Singapore, it's a lot of money for startup companies. And we also help them with less with strategy. I mean, because we invest in people that can execute the strategy. We can help them find team members if they're looking to staff up. We help them put systems in place so that they have good corporate governance. We help them find professional services firms, connect them with professional service firms like lawyers, accountants, auditors. We help them to get some media attention. We mostly help them to build the network, and increase their network. So it's some mentorship, some networking, some help with follow-on funding. For me, I focus most on follow-on funding. Because after you get, you think you're so excited, you got $500,000, and it lasts like 12 months or 18 months, and then you die. And yeah, it's like that. And the money goes very fast. So you have to get the next round, and you have to get it lined up now. And this is where we have a significant value add, because our network of investors is very broad and deep. And a lot of the investors that we know are interested in investing in deals that we already invested in, because they want to see us take all the risk, and then they can capture the return after the company is de-risked by us. Okay, this is like, now you get into some mind game, because people are thinking, if I ask another question, then no drinks, right? So, okay, oh, no, okay, yeah.
So you mentioned something about de-risking. So what exactly you try to do to minimize the risk?
Oh, so actually, I think the later stage investors think that we de-risk, but I don't believe in de-risking. Okay. Yeah, but I mean, it's okay. It is the case that if the company doesn't die after our stage, it's less risky, because we know that one risk has been eliminated, which was it was going to fail at the seed stage. So in that case, in that sense, we have de-risked. But I don't, I think we do, like our version of de-risking is we help the company raise more money, because another terrible risk is after seed stage, they won't raise more money. So in that sense, it's some de-risking. But I try to avoid the mindset of we can really reduce risk. We can only manage risk. I think risk doesn't ever reduce. It can be managed, but can't change. And it's good, right? Because actually we want a lot of risk, because that's how we generate the right return. Okay, I was going to say, I'll help you break out of this tension of should I ask question or get to drinks and networking, because I'm happy to stay around in networking and answer one-on-one questions. Thank you very much for your kind attention and questions, and looking forward to hearing from you after the program if you're interested in startups, venture capital, or anything else that I can help you with.